in finance and in business? Do you want more variance in standard deviation?
No, less.
You want less, right? So if I'm looking at stock portfolio returns amongst multiple investment vehicles, do I want to pick the one that's going to give me the highest variance in the standard deviation? No. Because the lower the variance in the standard deviation, the tighter the distribution is around the mean. Okay? And that's what we want. If you hear variance in investments and standard deviation, what's the first word that you think of? If there's more variance in standard deviation in the returns for that investment, is that investment more or less risky?
It's more risky.
Exactly. So variance and standard deviations are just measures of volatility and measure risk in business decisions, right? And then the confidence intervals. Do you want tight confidence intervals or wide confidence intervals?
Tight.
Yeah, you want tight. Okay. So if you got good confidence intervals, you have a higher probability of being able to predict in the future. Okay. Excellent. Can you give me the 3 confidence levels if I was testing the statistical significance of an independent variable's ability to predict the dependent variable? What confidence levels could I use?
95, 99, and
Is it 98?
And 90, yeah. So 99, 95, and 90. If I'm using 90, if I'm looking at 99% confidence level compared to 90, so I run basically the statistical test, the t-stat, to test the statistical significance of the independent variable's ability to predict the dependent variable. If I use 99%, is my t-statistic going to be higher or lower compared to the 90?
Can you repeat that?
So I'm doing a simple regression, okay? Independent variable regression against the dependent variable. I run it at 99% confidence level, and I run it at 90. Which one's going to have the higher t-statistic? The 99 or the 90? Now it's a 50-50 chance that you can get it right. So the probability is in your favor.
I was going to say 99.
Yeah, the 99 is going to give you a lower t-statistic because your confidence level is higher. There's a higher bar. It's not allowing as much error into the test, okay? So in physical sciences, they use, in most cases, 99% confidence levels to test the statistical significance between the independent variable and the dependent variable. Moderna vaccine on infection rates. You have to use a really high confidence level because you can't kill somebody, right? In social sciences, you know, okay, if we make a bad decision, we lose a couple $1 million. Okay, nobody died, right? So in social sciences, we use 95 and 90, so we can tease out the statistical significance between the independent variable and the dependent variable, okay? All right. Now, the Z statistic is called the student Z, okay, which is used for small sample sizes. But we don't like small sample sizes, right? We want lots of large samples. So the Z statistic is not used very much, but you know, we should at least know about it. The T statistic I just told you about is the test of statistical significance for the independent variable's ability to predict the dependent variable. And the T statistic range is between plus and minus 2. Okay, that's the range. And if you're getting a positive t statistic, there is positive correlation between the independent variable and the dependent variable. They move together. If the t statistic is negative, they move in opposite direction. And if the t statistic is 0, there's no causation, there's no correlation. There's no relationship. It shouldn't be in your model. Okay? The F statistic measures the statistical significance of your regression model to predict the dependent variable. So it's the model statistic. T is the variable statistic. F is the model statistic. Now, if I'm getting an F statistic of 8, the model's doing a pretty good job. Okay? If I'm getting 10, 13, it's a little high. There's probably multicollinearity in the model, which means I have variables in the model that are related to each other. And I'm going to have to figure out how to get rid of them. And if I'm getting 22 or 42 in my F statistic, I got too many variables in my model, and a lot of the variables are related to each other. So I got a problem. Okay? And most models have, good models have no more than 5 variables in the model. Okay? You need to write that down. These are all standards. Okay? I'm giving you all of the stuff I learned in my doctoral program. This is the best of. This is the best takeaway. Okay? This is like the best of I Love Lucy here, but in statistics. Okay? This is all the stuff that I learned that I took away with and then made the exam. The coefficient of variation, okay, is the standard deviation divided by the mean, or the expected return. It's the standard deviation divided by the expected return, or the mean. The inverse of the coefficient of variation is the mean expected return divided by the standard deviation. Okay? So the coefficient of variation and the risk-adjusted rate of return, the return divided by the standard deviation, gives me, the coefficient of variation gives me the unit of risk per unit of return. Unit of risk per unit of return. Unit of risk divided by unit of return. Okay. Do I want the coefficient of variation to be high or low?
Low.
You want it to be low. Got it. And then when I do the inverse, the risk-adjusted rate of return, which is the annualized or the average return divided by the standard deviation, do I want that ratio to be high or low?
High.
I want it to be high. So if I have 3 investments, they all return 10%. Did you have a question?
No, I
Oh,
think
no,
let's
I have
bring
nothing.
that out of.
Nothing after that.
Okay. So if I have 3 investments, they all give me 10% rate of return. For the first investment, I got 100% standard deviation. Second one, I got 50% standard deviation. And the third one, I got 10% standard deviation. Which one's going to give me the highest return to risk ratio?
10%.
Yeah, so I'm getting 1 unit of return per unit of the risk. The other ones, I'm getting a fraction of return per unit of risk. So if I had the choice, I would pick the third one. I'd pick C. So when we evaluate portfolios and investment strategies and companies that have divisions, and I'm looking at the risk-adjusted rate of return, I'm going to look at the return on those portfolios or maybe the revenues within those divisions, and I'm going to add in a volatility measure to get a risk-adjusted rate of return. So when I look at what divisions within my company are giving me the highest risk-adjusted rate of return, I'm going to be able to see which ones, well, yeah, maybe this one is giving me twice the return, but I'm taking on twice the risk. Okay? But the other ones are, I'm getting my 10%, but by diversifying across product strategies, I can lower the volatility and increase the risk-adjusted rate of return, so I'm better off. I'm getting my return with less risk. So I'm getting diversification. So we're better off. So these simple measures are extremely powerful for business decisions. The covariance. So the covariance is basically the average variance between, let's say, stock A and stock B. So it's just the average variance. So they co-vary together. So when you're looking at the covariance, you're really measuring, do these two stocks or time series, do they co-vary together? Do they move together? If I take stock A, stock B, and they co-vary together, am I getting diversification compared to taking two stocks that don't have a lot of, that don't co-vary together? Do I want a lot of covariance, or do I want a little covariance? A little, because then I'm getting diversification. Okay. So when I'm building portfolios, I'm usually trying to maximize the return to a certain level, and then I'm using investment strategy to bring down the risk, to bring up the risk-adjusted rate of return. Because I have a lot of clients that don't want 20% returns. They just want 10. I don't want 20 because I don't want to take the risk. Just give me 10. Because under the rule 72, I can double the portfolio in 7.2 years. But if I build the portfolio, I get you 10%, but I can lower the volatility, the covariance, the correlation amongst the stock and the portfolio. My risk goes down and my risk-adjusted rate of return goes up. So I get you your 10% at lower risk. Now you're talking. Now we're talking business. Okay. And then the correlation coefficient. So I got two stocks. They co-vary. The returns co-vary together. If they co-vary perfectly together, what's the correlation?
0.
No, if they perfectly are correlated. 1 or 100. Okay. So when the time series are highly correlated to each other, your correlation coefficient is going to start to approach 1. If they're perfectly, it's 1 or 100. Okay. If they move in the opposite direction, what's the correlation? -1, exactly. And when there's no correlation, it's going to be 0. So when I'm building product lines or I'm building portfolios, if I'm putting products or product lines or stocks or whatever into the portfolio and the returns are highly correlated, am I getting diversification? No. Am I lowering risk? No. If I'm putting stocks or products or divisions in the portfolio that have low, no, or negative correlation with each other, am I getting diversification? Yeah. Yep. Some people want to take on more risk. Some people don't want to take on more risk. So diversification allows you to piece together investments or product lines or divisions to basically target your returns, because it's going to be spread out amongst multiple ones, but by having offsetting revenue streams or returns, you can lower the risk and increase the risk-adjusted rate of return. That's what you're trying to do. Okay. The portfolio standard deviation equation. This is the portfolio standard deviation equation, not the standard deviation equation. Okay, so it's a little bit different. So you gotta give me the portfolio standard deviation equation. At the end of the equation, you can either put the covariance or the correlation, okay, on the two. And remember, if I'm building the portfolio and I'm lowering the covariance or I'm lowering the correlation, amongst the stocks in the portfolio, what's going to happen to the portfolio standard deviation? Is it going to go up or is it going to go down?
Yeah.
It's going to go down. So if I can piece together a portfolio and lower the covariance or the correlation amongst the time series, amongst those stocks or divisions or whatever they are, if I can lower these, I can lower the portfolio standard deviation. If I can lower the portfolio standard deviation, am I getting diversification?
Yes.
Yes. So if I can target the return and lower the portfolio standard deviation, is my risk-adjusted rate of return going up? Yeah. And if I can go to an investor and say, I can get you 10%, and I can get you higher risk-adjusted rates of return, what would they say? Got it. Here's my money. Invest it. Don't lose it. But if you can keep it up, I'll give you more. Okay? As the pensioners start to pay into their defined benefit programs, and you're investing on their behalf, so that you can grow the portfolio and double it in less than 10 years over the next 40 years, so that when everybody starts to retire, there's enough money in the portfolio to pay out their pensions. Okay? That's what they're trying to do. Matching the asset economic life with the liabilities. It's asset liability management. Okay, that's what we do for institutions. Okay, all right. What is the value of using regression? Why do you use regression?
You can essentially use to see trends in the market.
Well, what are you really trying to do when you build a regression model?
Predictive
Forecast.
You're trying to forecast. Okay? So the number one utilization of regression as a standard is for forecasting. Okay? So I'll show you, I won't do it tonight, but I'll do it next week. I'll show you the regression equation. Okay? I'll lay it out here and then you can put it in your thing. Okay? Because it's y hat equals alpha plus beta hat times x1 all the way to, beta hat 5 x5 plus the error term hat. And the hats mean that they're estimates. Okay? And that's the time series regression equation. Cross-sectional and time series regression. It's two different techniques, same methodology, trying to get at basically the same thing. But let's say I'm a startup company and I only have 4 quarters, of data. Can I run a regression on 4 quarters of data? No. But can I find maybe 25 firms similar to ours as a sample and basically test the variables to see what variables are statistically significant in their ability to drive revenue growth or returns or EBITDA, or whatever you're trying to forecast. So what I like is if I can't use time series regression, I use cross-sectional regression. One time period across multiple companies, same size, same industry. Okay? So I'm basically using a panel. Okay? I can run the regression, get the coefficients. Then what I can do is I can take the coefficients from the cross-sectional analysis and basically plug in the forecasts for those variables to forecast of our data to be able to forecast my small company's expected EBITDA growth rates for the next 8 quarters. So I can use cross-sectional regression to build the model to then pump in the forecasts to basically get a forecast. And then in 10 years, I'll have 40 data points, right, for the time series, so that I can revert over to the time series. But I'll probably end up running both techniques going forward. So I can use this as an interim solution to this if I don't have enough data. So they're extremely powerful techniques. Okay. And then this is always kind of stumps my students. Not only what is the dependent and independent variables, but how do you come up with it? So you go work, you're sitting in a meeting, and Gabrielle Gabriella?
Yeah.
So Gabriella, you're sitting around, and all of a sudden they're talking about being able to, you came in, you were just hired, you worked at 5 other startup companies, this is a brand new startup company. They basically look at you and say, hey Gabriella, you've been working at a bunch of startup companies, you did some consulting over the last 5 years for companies like ours, what should we be forecasting? What should a company like ours be forecasting? What do we need to be forecasting? Right, would they ever ask you something like that? No? No? Yeah, they will.
No, I mean, like, I never experienced something like that, but.
Yeah, well, it could happen,
Yeah.
right? You know, so you come in as an expert for a company with your background, and you know we need to be forecasting EBITDA growth rates, debt to equity, multiples. You know, we have basically a series of dependent variables that we want to be forecasting and tracking. And we want to know what the factors are that are driving these dependent variables for our specific industry sector. Okay? That the market's going to want to know and we're going to want to know internally. Then they're going to ask you, well, how did you build the model and what were the independent variables that you picked to basically forecast those dependent variables? Where do you get the dependent variables? Somebody asks you to build a model to forecast EBITDA growth rates over the next 8 quarters. How do you come up with the independent variables?
Okay, so wouldn't it be whatever you're doing different as opposed to other companies?
Huh?
Wouldn't it be like whatever you're doing different as opposed to other companies in your industry that are the
Well, my question is, they ask you to build this model, you got to come up with some independent variables. How do you find them?
Research.
You know, through what? What kind of research do you use?
Peer-reviewed, stuff like
You
that.
use academic research, so do you think you could go out and see if you can find some academic research papers on, you know, your industry of your company of your size that maybe the economists or the finance people or accountants have done that basically ran the tests on those variables to identify the independent variables that did the best job in predicting EBITDA growth rates for your chip manufacturing company? Yeah. So you go to the peer-reviewed journals. And if those variables come up over and over again, what's that called? The same variables keep popping up in multiple studies over time, over and over again. What's that called? What does that become?
Good evidence that it is a good.
It becomes theory. It becomes the literature. It becomes theory. Those variables need to be in your model for it to be legit, because those variables were used in a lot of academic and industry research, and these variables come up over and over again. Therefore, those variables need to be in our model, based on theory, okay? Based on the literature. So the question is, how do you select and determine these? Okay? Because theoretically, when you go work someplace, they're asking you to build models when they're asking you questions. In your brain, you're really building the model. And the question is, well, what am I trying to forecast? And what are the factors that are driving the, you know, what I'm trying to forecast? And where do I go to get the information to determine these things? One, I'm going to go to the literature, but where else am I going to go? Where else can I go?
An expert in the field.
Exactly. Do you think there's going to be experts in your company?
Yeah.
Yeah. And don't you think maybe the person that asked you to do this in the first place doesn't have time to do it? It might actually know some of these things. So that's all you got to do is reverse it and ask him or her. What do you think should be in the model? What should we be forecasting? And then you go talk to senior level executives within the firm and you do a survey. And then if you can, if it's not proprietary and you didn't sign an NDA, then you can go talk to other experts outside both industry and academic and survey them and take that information and come back and build a really good model and test it. Because the board's going to ask you, how did you come up with the model? How did you test it? Where'd you get the variables? What were the T and the F statistics? Was there some correlation? Was there skewed distributions? What were the results? What was the citations of the peer-reviewed journal articles that you used to identify the independent variables and build a model yourself? Do you think you're going to get grilled when you're talking about a multi-billion-dollar plant that you need to figure out if you're going to build in Gongzong? yeah, you're gonna get roasted, okay? So you gotta be prepared. Test the variable model statistical significance T and the F. Right? So I'm asking you again. How are you guys online doing? Are you guys holding up?
I'm doing good.
Okay. Multicollinearity. Two problems when you're running regression. Heteroscedasticity and multicollinearity. Okay. I'm not going to worry about heteroscedasticity today, but I do worry about multicollinearity. Okay. And the question is, what is it? And how do you solve for it? Now your problem is you're building a forecast model. You got variables in your model that are highly correlated with the dependent variable, but correlated to each other. You don't need both of them. So you got to pick one that you're going to keep and pick one that you're going to throw out. Okay? How do you make that decision? Which one to keep and which one to throw out? Anybody know? You got a model, your F statistics really good, but the problem is your T statistics are getting all squirrely because you got too many variables in your model that are correlated to each other. Your adjusted R square is really high, but again, you know, the model is too good and it's kind of screwing things up. So I got too many variables in there that are highly correlated to each other, and I got to get rid of one of them. How do I make the decision which one to keep and which one to throw out?
You could probably ask the person who asked you to build the model which one.
You could do that, but there's a more rules-based answer to it. Most students would say, well, I'm going to keep the one that's more correlated to the dependent variable and the one that has the highest T statistic. That's usually what the answer is. The correct answer is you're going to keep the one that's been cited the most in the literature, based on theory. Because it's come up over and over again over time using different data samples. So theoretically, based on the literature, it becomes theory. It's got to be in the model. Okay, so that's the solution. Internal validation, you're going to need internal validity for your model and the results and the recommendations. So you're going to need to get buy-off by senior level executives and other experts within your firm. If you can't get past those guys, it's not going to work. Okay? If they start questioning your data techniques and your data collection and your data and the results don't look right, they're going to start questioning. So you got to get internal buy-off first. Okay, that's really important. And then the external validity is basically the literature, you know, the industry and academic research that basically supports your model, but also the variables that you have in your model, so you can basically defend yourself in front of the board or the investment committee or senior level executives. Okay, and there's definitions around that too. There's two types of risks. Okay, when we're building portfolios and building companies, there's two types of risks. There's unsystematic risk and there's systematic risk. Which one of these two can you diversify away?
Unsystematic?
Unsystematic. So basically the graph, you know, basically here's your standard deviation or the risk, right? Here's the number of assets in your portfolio. So what happens is you add more assets to the portfolio that have low, no, or negative correlation. The unsystematic risk drops and becomes an asymptote. Okay? It becomes really thin. Doesn't touch the line, but becomes infinitesimally small. And everything underneath it is systematic risk. So we can diversify away business risk, product risk, market risk through diversification, but we can't diversify away systematic risk. And can you give me some examples of systematic risk? What can't you manage or diversify away? I'm a business person, I'm managing a company, right? I'm in an environment, right? What's controllable and uncontrollable? What's systematic risk?
You can't control like seasonal trends with purchasing patterns.
I can't control, I can control my inventories based on seasonal patterns, but I can't control the weather,
Yeah.
right? So that would be, I can't control COVID, I can't control a financial crisis, I can't control Congress from raising my taxes, I can't control the Fed for raising interest rates. So systematic risk are those uncontrollable risks, okay? It's the risk that's left after you've diversified the business risk. Now, I theoretically think that that's a good explanation, but it's incomplete, okay? I've been telling my clients, you are operating in a more systematic risky environment. Nothing that we've seen before, COVID, financial crisis, panics, a lot of these things. You as managers are now being confronted with more systematic risk than ever before. So what's the solution? What should we be doing as managers to offset the systematic risk? Diversify, but my solution is take on more unsystematic risk and push down the systematic risk. By focusing on your people, productivity, systems, 80-20 rule, focus on your, the 80% of your client, 20% of your clients that generate 80% of your revenue, quality control, marketing, management, prudent financing. You take on more unsystematic risk. Maybe move into markets, maybe go after market share, maybe upsell, cross-sell, new products to your existing clients that you already have locked in. So you're not going out and looking for new clients in a recession, you're selling into your existing client base. Okay, taking on more unsystematic to offset the systematic. And then I just ask you for some basic, can I use the balance sheet and the income statement factors as data to build models? Can I use the assets and the liability as dependent variables or independent variables and bring in economic factors to forecast my return on assets? Can I use the balance sheet, the income statement as basically microeconomic data, either as dependent or independent variables? Can I bring in economic factors to be able to forecast financial ratios? Can I use economic factors to forecast company financial ratios? Yeah. Yeah. So you're using macro factors and applying them to your firm's micro factors to be able to make forecasts on the financial statement. And financial statement data is readily available. And we build models on that stuff all the time. And then here are the key financial ratios. And then the last part, and I'm going to end it here. The last part, and I apologize for keeping you guys over. The last part of it is basically just definitions, from the book. Okay, so that's your pre-test, that's your quiz. Okay, and then what I'll do is I'll go through the midterm. Okay, I'll start working on that. You'll write out the notes, and then you'll submit those notes as the midterm. Okay? And you might want to go ahead and just read through it. Don't attempt to do the midterm. I'll start on it. And then, like next week, we'll do the market updates. We'll do the PowerPoint presentations, and then we'll work on the quiz. On the midterm. Okay? And then if you can bring the, a memo, that'd be awesome. Make an attempt at stocks. Okay, is this all doable? Is this okay? Is this working for you guys? Yeah. Okay, cool. Any questions?
So we're not submitting this for next week?
What?
The pre-test?
No, you just, you can do it on your own terms.
Okay.
Okay, so essentially for